excited to be here. My name is Guillaume Gousseau. I'm a business development director at Yahoo Finance. You all know Yahoo Finance, been around for 30 years, but believe it or not, we're actually active in the private market space. We launched in March of this year private company quote pages on Yahoo Finance through a partnership with Forge and EquityZen, which you'll hear from today. We're really excited to be part of this, to be playing a part in this market and creating more transparency. And obviously, it's a market that we continue to watch really closely. We're really interested to see how that goes. Combining the data and the news to help investors make better investment decisions. That's kind of our motto. And so getting into private markets was an obvious extension of that. And so I'm really happy today to be talking to these guys about private markets, what they are, how big they are, what are the challenges they face, what's the industry doing to kind of deal with those challenges and where we go from here. So without further ado, let me, I don't think you guys were introduced, right? I didn't hear your names. So I'll let you guys introduce yourselves, but let's start with you, Andrew.
Hey everybody, my name is Andrew Krashulik. I'm the Chief Operating Officer of NASDAQ Private Market. NASDAQ Private Market spun out of NASDAQ in 2021, but we've been around for over a decade serving private companies through company-sponsored liquidity events called tender offers. We also have our own trading platform called Second Market, whereby individual buyers and sellers can come and match and trade private securities. We have our workplace solutions that helps companies and executives with their entire employee base make financially smart decisions when it comes to the liquidity event that they're experiencing. And finally, we also have a data product that does daily pricing for over 400 private companies in this space called Tape D.
Excellent.
My name is Mitch Diarmando. I'm the founder of Steelwave Digital and ECI. We're really focused on bringing some of these large private assets, particularly U.S. commercial real estate, international sports teams, into this Web3 ecosystem, and really bringing some like-minded family offices and institutions along with it.
Hi, I'm Bree Lynch, Head of Market Insight at EquityZen. EquityZen is a leading platform for pre-IPO investing. We enable individual accredited investors to invest as little as $5,000 in late-stage private companies. You can think of the household names in Fintech, AI, space travel, and other industries. We've been around since 2013 and have built a network of over 800,000 investors and shareholders in the private markets, and we've enabled investments for them in over 500 of these late-stage private companies.
Eric Tomasian, I head company relations at Forge Global. We've been in the business of late-stage venture-backed trading for 10 plus years. We merged with a company called SharesPost, which is one of the original trading platforms in 2020. That went public via SPAC in 2022, and last week may have seen some exciting news from both of us. We were acquired by Charles Schwab. We're kind of have a few different business lines. Sort of our core is secondary trading. We also have a data business, we have a custody business, and we have an asset manager focusing on late-stage private companies.
Great, thank you. I guess we have the right panel on stage today for this topic. In a spirit of creating more awareness of this market, I want to spend a few minutes maybe, Bree, if you could kind of give us a little bit of an overview of what were we talking about when we say private markets? And Mitch, of course, feel free to jump in, but it is not just OpenAI and SpaceX.
Yeah, absolutely. And what we've seen on our platform is, yes, you hear about OpenAI, SpaceX, these names that are in the news all the time, but the private markets and even the pre-IPO market is so much bigger than that. In the last quarter, what we've seen is our investors are actually more interested in companies that are less than 10 billion in valuation, that are less than 5 years old, really driven by this thesis of, okay, how do I get into the next growing thing a bit earlier? And that thesis plays its way out when you compare public versus private markets as well. With the average company now staying private for 13 years, it's not like when Google and Amazon were going public 15, 20 years ago. So much of that upside has already happened in the private markets. That growth equity return is happening in the private markets, and that's what's driving more investors to the market. When we think about the investable universe, there's actually 6 times as many unicorn companies, so companies valued at over $1 billion in the private markets versus public markets. So there's just greater opportunity, and institutions have already always played here really, and now it's the individual investors we're seeing really looking for their way to access this growth as well.
Yeah, I would say private markets are the assets that everyone wants to play in, but very few people can. The scale is what differentiates privates, right? You have a lot of people that gatekeep how much money you have to get into them. Who do you know? How'd you get in it? Who's your recommending thing? It takes one person to say no, and you're not sitting on that cap stack anymore. So for us, we're like, look, if this whole Web3 tokenization ecosystem is really going to take the next step, it has to have assets in it that people can't get other places, right? Like money markets, simple securities. That's great. You go buy it on Robinhood, but you have a lot of opportunities for that, right? If you're taking like an international sports team where usually the minimum's 30 to 50 million, all of a sudden you're offering that to the fans. It's somewhere between like $5 to $10. That's what really changes this. We're trying to do it on the real estate side, and the scale on that's pretty big, right? The only way you can actually really do it is if you get like-minded family offices to come back the deal. And then they see this as kind of a liquidity play for them with their bigger positions, right? Think of it, CMBS round 2, you're slicing and dicing up that cap stack. But yeah, I mean, privates you have to get creative to really start stepping into them. And that's really the opportunity here for this next ecosystem.
Which leads to my next question, which is around, with the complexities and the opacity of this market, how do you create sufficient liquidity, and how do you even value these assets? So I'm wondering, Eric and Andrew, if you can kind of comment on that and kind of from your experience and what you guys are doing about that.
Yeah, I mean, from a valuation perspective, most things in the private markets trade based off of the last round of funding. And there's some sort of discount to that round and call it 10 to 30% kind of a normalized market. And then you have your OpenAI, SpaceX, and sort of the restricted companies where they're just harder to access, and you have a supply-demand sort of scenario where that creates premiums in the market and maybe even abnormal prices that are aggressive. And balancing that's actually one of the challenges of, how does the retail market sort of stay within range versus overpaying for something just because they want access. And that's, I think, where more capital actually to take down some of these larger secondary blocks or primary rounds or tender participation allows you to participate at more company guided prices than just individual buyers and sellers trying to sort of arbitrage the market.
Yeah, that's absolutely accurate. I would just add that there's kind of two different markets when you're in the private securities space. You're in the direct share market, which is buyers and sellers finding each other either through a broker or organically. And then there's also the broad-based liquidity programs through tender offers that are always company sponsored. Within the company sponsored world, you always have data. It's always provided. There's a data room. It usually includes pro forma financials, sometimes audited financials, years of projections, risk factors, the previous fundraises, investor deck, and even more. And so there's a lot of information that's provided in those types of offerings. And what we've seen across the 800 or so tender offers is more often than not, the price discovery is a fairly simple process. It is oftentimes based off the last fundraise. But what we've been seeing more and more is actually, it isn't just the rule of thumb that it's a 10 to 20% discount from the last fundraise. It really depends on the name. Sometimes you're getting premiums to the last round. Sometimes you're getting 10, 20% premiums depending on that name. But what we're seeing more and more in this market is actually people are willing to pay up just for access to these names. It is not just about, I want to look at the financials, this is a good investment. It can come down purely to, I want access to the private markets, and people are willing to pay for that now.
And speaking of which, what do you, Bree and Eric, if you could comment a little bit on the infrastructure that underpins all this? I know you guys have built a transactional platform to allow this market to become more liquid and more transparent. What is changing? What have you're seeing as far as how these infrastructure of private markets evolving to, I guess, facilitate more transparency, more liquidity, and easier valuations?
I mean, quite simply, we couldn't do what we do at Equity Zen without technology. There's no way that you can take the arduous process of private market transactions where you need the company's approval, special documentation between the shareholder and the investor and the company and everything else in between, and do that in a scalable way without technology. So technology is what has enabled us to broaden access, to offer those $5,000 minimums. And that's really what we see being the main scaling factor looking forward. And, we've built a tech platform. It's something that we're continuing to evolve as the needs of our clients change. So we talk to our investors and clients on the platform, and they tell us what they're looking for. This year, for instance, we launched a bids feature where an investor can go on and instead of seeing, okay, you have X stock available at $50 a share, I actually want to buy 1,000 shares of that at $48.50. They can place that bid to a seller, and if a seller agrees, they can actually match and that transaction can happen. And that may seem very basic for public market investors. Like, this is not anything revolutionary, but for individual non-institutional investors in this market, this is a huge tool that's giving them a lot more autonomy and bespoke abilities in how they trade. We're seeing trades match faster from it. So that's just an example, but I think going forward, technology is going to be the thing that enables greater access and just provides more liquidity to the market.
I just will comment a little bit more on the evolution of structure and companies permitting transactions or not. 2021, 2022, at kind of the height of the market, there was a much broader universe of companies that traded and didn't have transfer restrictions. Over the last 5 years, because valuations sort of, tanked and then are starting to come back outside of the AI and kind of defense aerospace sector, a lot of companies became a lot more sensitive and protective over who can be on their cap table, what price you're trading at. And these restrictions have actually basically caused the SPV model to become sort of the only way to get access to certain names. And so there's kind of this push and pull between companies wanting to control price and their cap table, but that sort of pullback on liquidity creates a lot of tension in the market with SPVs because only a certain subset of investors have access and are charging fees that are aggressive for, just getting access. And so you're seeing multiple single, double layer SPVs as a new kind of phenomenon in the market versus, just being able to have direct share transfers that Andrew alluded to.
I just wanted to add on to that. The technology in the marketplaces is as fascinating as it has evolved over the last 10 years. What is amazing about the direct share market is that the buyers and sellers coming together and matching, that is very, very tech driven. But a lot of the rest of the process is much more similar to buying or selling a home in terms of actually settling these trades. Much of what we see in the market, particularly around transfer restrictions, involves co-sale rights and ROFR as well. And so what happens with a lot of these transactions is that you need to develop a relationship with the company in order to really facilitate these at a speed that actually makes sense. Because typically a ROFR timeline can be anywhere between 30 and 60 days or never if a company decides not to respond to it. Because at the end of the day, the way that a lot of these documents are written for these shares is that the company needs to provide affirmative consent, meaning that a company can only approve a transfer. It doesn't have to deny it, doesn't have to say we're outright blocking it. They can just not respond and effectively deny that trade. And so there's still some work to be done on the infrastructure side on settling it so that you can reduce settlement times, reduce settlement risk. There's lots of technology that's out there, but because of the way that a lot of these securities and their ownership is worded, it becomes very difficult because there's a lot of gray area and a lot of flexibility, which is actually valuable to issuers.
Yeah, I mean, look, the biggest thing that we deal with is, over the last, I'd say, since 2017, it seems to be everyone talking about different layers of tech and here and there. And for us on the capital market side, it's like, look, the tech's going to be the tech. We really look at this as who has the ability to scale with the assets that they're having on their platform, right? That's where it's like, okay, if you're taking a company like OpenAI, that's very interesting. But if you take it on like a deal side, where it's like, okay, one team selling it to the fans, you add a different layer of complication. But half of our job is educating people, right? When I sit down with hundreds of these family offices, especially internationally, and I just walk them through the optionality they have, I'm like, hey, just so you know, usually 5 to 10 year lockup period, we'll get you liquidity in 12 to 24 months. They lean forward. They're like, okay, that's something that draws their attention, right? And if you have a deal itself that's attractive enough, the family office will like that, and liquidity is just the icing on the cake. And that's half of our problem right now. So it's getting the tech, getting the regulation to the right space, but it's also providing the right assets that people want to come play in to do that.
Great segue into regulation, our favorite topic. How is it hurting or helping this marketplace? Andrew and Mitch.
I mean, look, I think the U.S. is going to be last, to be honest, right? I think, at least for us, we're looking at it going, okay, we got to do international family office, international entity, international asset, and then you can list it on international exchange. I think that'll change over the next 18 to 24 months, but I do think regulators need to wrap their head around simple projects before they start getting into these large scale private deals. I mean, on the real estate side, like if we were going to go try to tokenize a development deal, how are you going to handle a cap call, right? There's certain things that there's limitations around that I think the U.S. still needs to iron out, but I think we're going in the right direction. And I think with the new administration and the people that are surrounding this topic, you're starting to see actual thought leaders in the room.
I would just add that I think there's a lot of work to be done, particularly in the space that NASDAQ Private Market works in. You're not necessarily, as a private company, want just anybody investing in your name, right? You create a lot of value as a private company because you're allowed to focus on building what you're good at. You don't have to worry about IR. You don't have to worry about doing quarterly audits and all of these types of things that you can think of as a public company. And so what we typically see is that this illiquidity really is a feature, not a bug, right? And the idea here that accredited investors can come into the market and that they can invest, I think that is fantastic to get access to these names when they are creating this value. I think the regulation needs to continue to be improved and really built up so that there are clear guardrails around who can invest and when and why and what needs to be provided. But at the same time, we also have to respect what the issuers really want here, and that's to build a great company, remain private. They're not here for the retail investors necessarily. They're here to build something amazing so that eventually there can be value for lots and lots of investors. So I would just leave it at that. I think that there's work to be done, but I think it's amazing to see just where the market has come in 10 years. The lack of transparency has given way to more data products, given way to more marketplaces. And I think that is where you need to start with the framework for regulation, is that there is information that is out there that is quantifiable and transparent.
Thank you. That's great. I want to give each one of you a chance to kind of talk a little bit about going forward. What do private markets look like? Where do you see the big trends, tech, regulatory, whatever, all the things we talked about, how you see this evolving in the next few years. Maybe we can start with you, Eric, and kind of go this way.
Yeah, I mean, I think that, and you've seen it just with the headlines in the last week or two, the movement is how to integrate private markets to capture a broader audience. So wealth management is definitely forefront for a lot of the big banks. A lot of, how do you tap into retail capital, but make it sort of palatable for companies and for bigger investors and not have to, meet certain minimums. I think there's going to be a movement into index funds, sort of passive private market fund structures. There'll be thematic funds where you'll own a lot of these names, so you have exposure not to just one. And those are probably, I'd say, like the two main themes that I've seen really like emerge over the last year, is sort of like this passive index concept, and then how private markets generally will drive wealth management, which is a bigger sort of revenue stream than simple brokerage trading.
Yeah, I would echo some of what Eric said there, but I do think that it's kind of undeniable now this idea that private markets are mainstream and that the average investor needs an allocation to private markets to have a well-diversified portfolio. You see that with BlackRock CEO saying that private markets are going to be a key part of their model portfolios. All of these things kind of take these institutional investment opportunities and bring them downstream. So I think that's a trend we're going to continue to see. But kind of touching on some of what was covered in the regulatory part of this, there's a lot of risk that also comes with that. And I think education becomes increasingly important. We talk to so many investors who don't even realize that this is an option for them. They don't even know that individual investors can be investing in these companies. So I think there's a real opportunity and a need to educate the market a bit more about how these transactions work, how to build a diversified portfolio and make a basket of names instead of putting all your chips into SpaceX or whatever it might be. So I think we'll see a trend where, yes, the market broadens so more people can participate, but then the real question becomes who can do that in a way that educates all the market participants as well as possible and creates a safe path for investments.
I think private markets are going to look a lot similar to what public markets look today, but on a global scale, right? I think you're going to start to see, certain jurisdictions put in parameters around what the requirements are for each offering. But then once those parameters are set, you're going to start to see offerings hit market and then sell globally. I do think you're going to see the retail investors start to play a bigger role, not so much in the primary issuance, but definitely in that secondary market play, right? And I think that's a good thing, right? I do think, private assets, there is more of a risk to them. So, you have to have these bigger institutions come eat bigger pieces. Once they have like comfortability, they want to get liquidity, start bringing it to the retail. But I think that's where the puck's going right now.
Is that through tokenization?
Yeah, I think it's through different concepts, but I think tokenization is the one we're pointing to right now. We've tossed around a couple of different ideas of launching a stablecoin derivative of teams. Packaging up a bunch of teams and doing an ETF offering, stuff like that. But I think direct to market, we're looking at, implementing some of these tokenomics behind, controlling where you're releasing the coin, how much you're releasing, where does that price dynamic go, especially as the team starts to appreciate. Do you pay dividends? Do you not pay dividends? So there's stuff we're still thinking about here. And to be honest, I think every day it changes, right? Like every day, you see the Genius Act coming, you see clarity coming into play, right? You see the banks fighting the Genius Act, right? So we're really on the front edge of something that it's rattling the cages of a lot of these big time institutional players that have been gatekeeping these investments for a long time, right? But that's how you get fees, right? Schwab doesn't buy nice houses because they grow on trees, right? You got to have fees somewhere. So I think it starts to open up a lot of these markets.
Schwab buys great assets, I can tell you that. What I would say for the private markets and trends is that we have seen just massive explosive growth in individual single name secondary sales. And so for the tender offer market, we've done 800 of these. We've done $65 billion worth of tender offers at NASDAQ private market. 3 years ago, we did $3.5 billion. Last year, we did $6.5 billion. This year, we're probably going to do $15 billion. That is just a massive number that is on the scale with certain segments of the IPO market. I mean, there's $110 billion of IPOs this year. 55 billion have been tech IPOs. So in not too long, the tender market and these large company-sponsored broad-based secondary programs could overtake the IPO market in terms of volume. Companies do not need to go public. It is just a fact. They can stay private for as long as they want. We see companies doing this more and more. The average company used to IPO when they were 4 years old. Now it's well over 11 years old. In fact, the median age of a company that comes to NASDAQ private market is 11 years. We see companies that are 15 to 20 years old coming back and running something like their 10th, 11th, or 12th tender offer with us because they're now starting to do this year over year. And so one of the trends that we're seeing with private companies is that you no longer just have your 401k, your health benefits, your FSA. You also need to have a very, very fully baked equity-based compensation plan and a liquidity plan as well. Because engineers are showing up. You're having C-suite execs show up and they say, what sort of liquidity do you provide? When was the last liquidity you provided? They're getting really smart on this. And so we're seeing more and more of these players who are not institutional level, they are effectively retail level, coming in and asking companies about this and asking them to come up with a plan. So not only do I see it going that way, I also think, tokenization is a fantastic bit of technology. It's amazing for settling things that have really, really well-defined rules. But as I mentioned earlier, a lot of these share transfers do not have well-defined rules, and that is something that companies want to keep. It gives them that flexibility. It gives them the control that they want and deserve. And so I see tokenization helping in a lot of different areas. And when it starts solving a problem for a lot of these private companies, I think that's when we'll start seeing it come more and more into the direct share secondary market. For now, there's lots of interesting ways for retail investors to get into these private names. You can come through SPVs, which a lot of the fellow panelists here have explained. But there's also going to be much larger evergreen fund structures that you're going to be able to invest in. And a lot of that is going to provide more and more data into the market as well. There's already fund structures that allow you to invest into private company names. Think about mutual funds. They have to do quarterly mark-to-markets. They invest in private companies up to a certain percentage. They provide that data. It's out there. Companies have to do corporate filings every year. There is trading information. So we're getting more and more transparency. We're getting more and more data. And I think that when we have more vehicles and structures to be able to allow retail investors to actually get exposure to these names, you're going to see continued growth in a lot of these structured programs rather than individual one-off trading, because that's where the supply is. And that's where buyers want to show up. You want to show up to do $15 billion a year, not 150K. And so that is where I think the market is going to continue to grow exponentially. We're even starting to see earlier and earlier stages run tender offers. So we now have about an even split, Series A all the way to Series I and later across all the companies who are running tenders. So this is just phenomenal to see 25% of the companies in Series A and Series B, early stage companies running it. I think that's going to continue.
Anybody care to respond?
I just have a comment that kind of piggybacks off the data side. And you're completely right. Like, as the market grows, the need for data is important, and individual investors aren't getting access to the data rooms that you're talking about that institutions are looking at. But what we've kind of seen from our platform, as we've done this for 10, 13 years, is actually these transactions, the exhaust pipe of doing these transactions is a ton of data. So we're sitting on, millions of data points about bids and asks and, what industries are trending up, what companies are trending up before we're actually seeing that from the transaction side of things. So I think we're just kind of like at the tip of the iceberg of what private market data can be provided to retail investors. We're partnering with Yahoo Finance and sharing some of that with their audience, but there's just so much more that we're starting to share and can share to help level the playing field a little bit. So I do think, data is key to this as well.